Welcome to vTalkInsight, Risk Sentiment Daily for April 17, 2026. Global equities are pressing fresh record highs even as a powerful Middle East energy shock keeps stagflation fears alive. Let's look at how that tension between upbeat earnings and mounting macro risks is shaping today's risk appetite. Risk sentiment today is decisively risk-on but with visible cracks underneath the surface. U.S. equity indices have pushed to new records, with the S&P 500 closing above 7,000 for the first time and posting another small daily gain, while volatility gauges drift lower toward the high teens. The rally is no longer confined to mega-cap growth. Gains are broadening across benchmarks, and global equities have rebounded sharply from the recent drawdown. That strength sits alongside a deteriorating macro backdrop, dominated by an entrenched Middle East energy shock and rising inflation worries. Physical crude prices are up more than 30% since the conflict began. Supply through key shipping choke points remains disrupted, and gasoline and jet fuel costs are biting into sectors like airlines and parts of emerging Asia. At the same time, equity risk premia and headline valuation multiples point to expensive indices, even as risk premiums demanded over pre-war levels have risen, highlighting how much good news is now embedded in prices. Compared with recent days, the broad picture is unchanged. Earnings, AI, and credit resilience are keeping investors engaged, while energy, inflation, and policy uncertainty form a growing overhang. Flows are rotating out of cash-like fixed income into risk assets, but emerging markets are seeing heavy portfolio outflows and consumer sentiment is sliding despite equity highs, underscoring the K-shaped nature of this cycle. Overall, the tape remains risk-on with fault lines, suggesting portfolios are being rewarded for taking risk today, but are increasingly exposed to any shock that challenges the current growth and earnings narrative. AI-driven earnings and tech leadership remain the single strongest bullish force supporting risk appetite. TSMC has reported a 58% year-on-year profit surge, with first-quarter margins around 66% and sales beating guidance, driven by relentless demand for AI chips. Management now expects AI-related products to account for more than 60% of revenues, has lifted its revenue growth outlook to above 30% annually, and is openly signaling potential further upgrades into 2026. That momentum is radiating across the semiconductor ecosystem. Chip equipment makers such as ASML are reinforcing the upbeat tone, while semiconductor indices have outperformed software peers by a wide margin since the late March bottom, with hardware names capturing most of the post-sell-off upside. Large technology platforms and hyperscalers are racing to secure capacity, with some willing to pay above market prices for advanced fabrication equipment, underscoring the urgency and perceived durability of the AI infrastructure build-out. The growth story is not confined to chips. Anthropic's annual recurring revenue has reportedly jumped from $9 billion to $30 billion within a year, with projections that its AI product revenue run rate could surpass the combined totals of several major software-as-a-service peers. That combination of rapid top-line growth, high margins, and capital spending by both suppliers and users underpins upgrades to index-level earnings expectations, helping justify some of the equity market's resilience in the face of macro shocks. There are, however, important caveats around this theme. Recent AI-related capital expenditure deals, such as large cloud infrastructure commitments, are starting to raise questions about sustainability, and signs of speculative excess are visible in smaller companies pivoting to AI narratives without clear fundamentals. Severe cybersecurity vulnerabilities uncovered by advanced AI models also highlight that the same technologies driving growth could introduce new tail risks, making ongoing earnings delivery and risk management the key metrics to watch for this leadership group. Alongside AI leadership, a broadening equity rally and strong risk inflows are reinforcing the risk-on tone. U.S. indices are not only hitting new highs, but gains are now spreading beyond the largest technology names towards smaller companies and cyclicals. Indices such as the Russell and small-cap benchmarks are approaching all-time highs as earnings inflect from 2 years of contraction to expected double-digit growth this year, while value stocks benefit from robust underlying activity. Capital flows are echoing this shift. After a period of defensive positioning, Investor money has moved out of cash-like fixed income into equities, with U.S. stocks seeing their strongest 8-day inflows in some time and hedge funds pivoting from wartime hedges toward post-conflict opportunities. Gulf issuers have returned to international bond markets, raising nearly $10 billion, while high-yield credit spreads have normalized and default expectations linked to the Iran conflict remain muted. That said, the broadening is far from uniform. Emerging markets are suffering portfolio outflows roughly double those seen in 2022, and sectors directly hit by higher fuel costs, such as airlines and travel, are under pressure as guidance and margins deteriorate. Consumer sentiment has fallen sharply even as equities rally, and survey evidence points to a widening gap between corporate performance and the lived experience of many households, reminding allocators that the current risk-on phase rests on uneven foundations. A resilient credit and financial system is another important support for risk sentiment. Despite geopolitical shocks and the energy spike, high-yield and leveraged loan markets remain open, with little evidence of a broad wave of downgrades or defaults tied specifically to the Iran conflict. Tight credit spreads reflect both ample liquidity and declining corporate yields, and many investors see corporate credit as relatively attractive compared with government bonds, given rising sovereign debt burdens. Private credit, a key focus for institutional portfolios, is also stabilizing after a period of concern. Spread widening and retail outflows have created what some see as more appealing entry points, but institutional allocations continue to grow, and investor interest is broadening beyond direct lending into real estate and infrastructure-backed debt. Blue Owl, for example, has staged a sharp rebound after management reassured markets about its exposures, while upcoming earnings from public business development companies will be watched closely for how they mark loans amid public market volatility. Traditional banks are reinforcing this picture of systemic resilience. Major U.S. institutions have delivered strong trading revenues and healthy wealth management inflows, and European banks are expected to report double-digit increases in trading income, building on U.S. peers' upside surprises. At the same time, firms such as PNC highlight the historical robustness of senior collateralized loan obligation tranches, suggesting that, while pockets of credit risk exist, the main transmission channels from private credit into the broader system appear limited for now. Even here, there are risks that could challenge the benign view. Central banks have stepped back from large-scale sovereign bond purchases, increasing reliance on more price-sensitive buyers and potentially heightening volatility and liquidity risks in rates markets. Concerns around how private credit marks loans during periods of spread volatility and the possibility of sudden redemptions in newer vehicles such as Bitcoin exchange-traded products are reminders that liquidity can evaporate quickly if sentiment turns. On the bearish side, the Middle East energy shock and associated inflation risk remain the central macro threat to risk assets. Shipping through the Strait of Hormuz and surrounding routes has been heavily disrupted, with estimates of more than 10 million barrels per day of supply temporarily lost and commercial activity hampered by blockades, insurance constraints, and security concerns. Physical crude prices have surged more than 30% since the war began, and some grades are reportedly changing hands near $150 per barrel, far above pre-crisis levels. The consequences are spreading well beyond the oil complex. Global crude benchmarks such as Brent are approaching $100, with forecasts that prices could reach that level by the end of June and remain elevated as strategic reserves, already drawn down by roughly 500 million barrels, are rebuilt. Higher fuel and input costs are squeezing margins in energy-intensive sectors, prompting airlines to raise fees, trim routes, and issue cautious guidance, while some Southeast Asian economies face outright energy shortages that threaten to reverse years of development. This backdrop raises the risk of a stagflationary shock in coming quarters. Inflation pressures from energy are feeding into broader price levels and could push central banks toward higher-for-longer policy stances just as growth data begin to roll over, particularly in more energy-dependent regions. China is better positioned than many peers thanks to large reserves and expanded coal and renewable capacity, but it too is expected to draw down stocks and cut refinery runs if disruptions persist, underscoring that no major economy is entirely insulated. There are some offsets, but they also highlight a potential complacency. Iran's willingness to allow shipping through neighboring waters suggests recognition that it cannot indefinitely control key choke points, and many financial prices still appear to assume that ceasefires will hold and trade routes will gradually normalize. If the region fails to de-escalate or the Strait of Hormuz remains constrained into the third quarter, markets may need to reprice both inflation and growth expectations more aggressively than is currently reflected in asset prices. A second major headwind is elevated valuations, concentration, and mounting bubble risk in parts of the equity complex. Headline valuation metrics show the S&P 500 trading around 25 times earnings and Eurozone equities near 17 times, levels that look demanding after a record-fast rebound from the recent correction. Equity risk premia have actually risen relative to pre-war norms, meaning investors are demanding higher returns for the same dollar of future earnings even as they continue to push indices to new highs. Beneath the index level, leadership remains narrow and crowded. Recent gains in the S&P 500 have been dominated by a small cluster of mega-cap technology names, with estimates that the largest group of tech leaders account for the vast majority of index advances. Anticipated mega IPO activity in AI and space-related firms could further increase index concentration and amplify the dominance of a handful of technology platforms in both equity and credit markets. There are also growing signs of speculative behavior. Rallies in companies merely adopting AI or cloud branding without clear fundamental backing, together with heavy positioning and fear of missing out dynamics, suggest that recent price action is being driven as much by momentum and short covering as by earnings or macro data. At the same time, large technology issuers are increasingly active in bond markets, raising concerns that equity and credit exposures are becoming more tightly linked, which could increase systemic risk if sentiment around a few names reverses. Some investors are already adjusting to these risks. There is growing interest in equal-weighted index exposure and active stock selection rather than chasing broad benchmarks, reflecting discomfort with concentrated market cap structures. Still, comparisons with previous speculative episodes and the potential for abrupt liquidity shocks in adjacent areas, such as large exchange-traded products linked to crypto assets, underline that parts of the market could be vulnerable if the AI narrative or capex outlook disappoints. The third key bearish driver is a persistent policy and geopolitical uncertainty overhang. Efforts to extend the U.S.-Iran ceasefire remain unresolved, with discussions around asset freezes and secondary sanctions keeping nerves frayed across energy and shipping markets. Even if open conflict subsides, the IMF warns that the economic fallout from the war, including damaged infrastructure and dislocated supply chains, is likely to linger well beyond any formal peace agreement. Monetary and fiscal policy add further layers of uncertainty. Sticky inflation near 4% and accelerating U.S. earnings have led markets to assign a very low probability to near-term Federal Reserve rate cuts, and some see a risk that the terminal rate needs to move into a 4 to 4.5% range, which would pressure risk assets and support the dollar. At the same time, governments are increasingly relying on shorter maturity debt to contain funding costs, raising future refinancing risks as large volumes must be rolled over in potentially volatile conditions. Institutional stability and regulation are also in focus. Political threats to Federal Reserve leadership and central bank independence are viewed as low probability but high-impact tail risks that markets may be underestimating, given the potential for sudden shifts in policy or communication. Regulators are probing suspiciously timed trading in energy derivatives around key policy announcements, and extended shutdowns in areas such as U.S. Homeland Security funding highlight how governance frictions can spill into operational uncertainty. The impact of this uncertainty is uneven across regions and asset classes. Emerging markets are experiencing portfolio outflows roughly twice the pace of 2022, reflecting heightened vulnerability to external shocks, while developed market credit and equity markets still appear relatively sanguine. This divergence underscores why geopolitical and policy developments remain a critical watchpoint for portfolios, even as day-to-day price action continues to signal confidence. To sum up, risk sentiment today remains firmly risk-on, powered by AI-driven earnings strength, a broadening equity rally, and resilient credit markets, yet it is increasingly constrained by a severe Middle East energy shock, rich valuations, and a noisy policy backdrop. For portfolios, that means upside is currently tied to continued delivery from a narrow group of AI and growth leaders, while downside risks cluster around energy supply, inflation, and any loss of confidence in central bank or geopolitical stability. Watching how these forces evolve, especially the balance between physical energy strains and still optimistic financial pricing, and between earnings upgrades and valuation excess, will be crucial in assessing whether this risk-on phase can persist. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.